Good day. Welcome to the second module of Fundamentals of Accounting, Business and Management 1, the Accounting Concepts and Principles. For this video, I will be identifying different concepts and principles of accounting and providing specific situation that either follows or violates an accounting principle. Now, what are the accounting principles and what are these for? Accounting principles are the general rules and guidelines that companies are required to follow when reporting all accounts and financial data. The purpose of following accounting principles is to be able to communicate economic information that is acceptable and understandable from one business to another. Accounting principles also ensure that companies follow certain standards of recording how economic events should be recognized, recorded, and presented. Let us discuss our first accounting concept, the business entity principle. Business entity principle states that the business enterprise is separate and distinct from its owner. Therefore, only transactions relevant to the business are recorded. For an instance, Mr. Archel has acquired a floor of a building having 3 large rooms for 75,000 pesos. He uses 2 rooms for his business and the other one for personal use. According to business entity concept, how much is the valid expense of the business? Again, according to business entity principle, an enterprise is separate from its owner. In this case, Mr. Archel acquired 3 large rooms worth 25,000 each. However, the single room is used for the owner's personal consumption. Hence, this will not be recorded on the firm's book. Now, the valid expense for the business is 50,000 pesos for 2 rooms used by the business. Next, the going concern principle. Going concern principle implies that business will continue to operate indefinitely and will neither liquidate nor be forced to discontinue, meaning the business is assumed to exist forever. But if evidence affecting the performance negatively, such as series of losses, loan defaults, denial of credit, is available, then the firm is no longer a going concern. For a better illustration, a food processing company manufactures a luncheon meat. However, the Philippine government imposes restriction on the production, exportation, marketing, and sale of this product in the country due to African swine fever. If luncheon meat is the only product that company manufactures, the company will no longer be a going concern. In this case, the enterprise's only source of income is their luncheon meat product. But they are forced to discontinue the production and marketing of the product due to African swine fever, a contagious viral disease for swine that causes massive deaths among pigs that decreases its supply. The enterprise may face losses and undersupply, an evidence of discontinuation of business. Thus, the company will no longer be a going concern. Third, the time period principle. Time period principle implies that a business should prepare and report financial results in specific time periods, which is usually monthly, quarterly, or annually. That is why financial statements like this, simplified cash flow statement, has specific years in it to identify the coverage of the following accounts. As you can see, there is 2019 and 2018 years there, This standardized income statement shows also the covered period of inclusive amounts. So it says that this is the income statement for the year ended December 31, 2015. Time is as important as cash in accounting. Monetary unit principle, on the other hand, basically states that business transactions expressed in currency only are to be recognized and recorded. Fifth, the objectivity principle. In objectivity principle, financial statements must be presented with supporting evidences, for an instance, proof of purchase, receipts, invoice, and other relevant documents for it to become more accurate and reliable as basis for future company's performance. Example, Carla, an accountant, is in charge of preparing financial statements for Elite Incorporated. Carla asks for company records to support its payables and receivables, but the company says it will be too much work to get and just go with the numbers in the accounting system. It violates the objectivity principle because there should be at least proof of purchase, receipts, invoice, and other relevant documents supporting the payables and receivables. Sixth, the cost principle. Cost principle requires that assets purchased should be recorded at the cash amount at the time that an asset is acquired. For an instance, when McDonald's buys a cash register for 50,000 by paying 20,000 and promising to pay 30,000 within a reasonable period of time, it should record the asset at its price when they bought it, which is, of course, 50,000 pesos. Seventh, accrual accounting principle. Accrual accounting principle implies that revenue and or expenses should be recorded once it occurred regardless if the payment is received or made. For example, when Lucretia, a dentist, finishes performing her services, she should record it as revenue regardless if the client paid her or not. When Lucretia receives an electricity bill, she should record it as an expense even if it is unpaid. Lastly, the matching principle. The matching principle requires that revenues and other related expenses be recognized together in the same reporting period. For an instance, a salesman earns a 5% commission on sales recorded in January. The commission of 5,000 is paid in February, but commission expense should be recorded in January. A company acquires equipment for 100,000 pesos that has projected useful life of 10 years. Depreciation expense should be charged at the rate of 10,000 pesos per year for 10 years. So that's it. I hope that you learned something. Thank you for watching.